Hello and welcome to this very special interview. We are going to talk about balanced advantage funds, which actually have emerged as one of the most popular categories. And actually, if you look at it, this was probably a product which should have emerged many, many years ago, because every financial expert will tell you the importance of asset allocation. And here is a product that does exactly that without you or me as an individual investor having to do anything. The reason I describe this as a special interview, because I have two veterans, between them more than half a century of experience. Sanjay Chawla, who is the CIO for equities at Baroda BNP Paribas Mutual Fund, and Prashant Pimple, who is the CIO for debt or fixed income at the mutual fund house. 5 years, the BAF that both these gentlemen manage has completed and is one of the best performing balanced advantage funds. So let's dive straight in and try and understand what is it that they've done right, and why should an investor consider BAF as a category. Let's try and understand that. So let me come to you first, Sanjay, that on the equity side, and we'll discuss the debt side with Prashant in just a bit, but on the equity side, what is it that you've done in terms of your investment style, in terms of what sectors, what categories have you picked that has resulted in the success of this fund?
Sure. So first of all, thank you, Vivek, for having me on the show. It's a pleasure to be on the panel with you and with my colleague Prashant. It's an honor. When we talk about the investment strategy for this fund, I would actually place it that there are two parts. People say it's the art and the science, and I would reverse it, and I would say it's the science and the art, where the science actually comes before. The science part is, how do you determine the net equity allocation that you're going to be making towards this fund? Okay. So we've developed a model. There's a science behind that. And based on that, we determine what's the net equity allocation we're going to have and how much is the debt allocation out there. So that's the science part. The art part is, of course, in terms of once the net equity is determined by the model, how do we take the sector call and how do we take the stock call within the sectors. The sector call is typically done on a top-down basis where we look at the macros, how is the economy doing, at what stage it is at, what are the factors and which could actually impact the sectors. Then we look at the sector parameters, and based on that, we decide whether we want to be overweight or underweight. And then we come to the stock calls. When we look at the stock call, we have an overarching philosophy, what we call the BMV principle. We look at business, we look at management, and we look at valuation. Just staying focused on the valuation part. Within that, we are a growth-oriented investors and we follow a GAP philosophy. So that's the overall arching view that we have when we are looking at this fund. And that's the investment strategy that we follow in our Baroda BNP Paribas Balance Advantage Fund.
Prashant, as a fixed income expert, are you happy that, finally debt seems to be getting the due importance that it probably always deserved? But, somehow when one said mutual funds many, many years ago, it meant equity. And, debt meant liquid funds where corporates would come and park their money. We've seen, of course, lots of innovations on the debt side. But now I think people are beginning to understand the importance of debt in a portfolio as well. So before I come to your strategy, I want to understand from you, for the investors, for the viewers, what is the importance of debt in a portfolio, and why is it so important to at least have some part of your savings in debt as well?
Yeah, thanks, Vivek. Thanks, Sanjay. rightly asked, Vivek, I think has become one of the important pillars of any portfolio allocation strategy. Why debt is important is the intention of having debt allocation in any of the portfolio is basically to give stability to the portfolio from a risk return perspective. Similarly, in the current portfolio, that is balance advantage fund also, our intention is to give stability on certain portfolio allocation of the overall scheme. And that's how we are deciding on the strategies depending upon the interest rate scenarios in the past, going ahead, and currently also. And that's how we are allocating the allocation to debt, which is being basically the outcome of the model which Sanjay just spoke.
Sanjay, can you tell us a little more about the model which determines the science part that you talked of, where on the basis of which you determine how much in equity and how much in debt?
Sure. So this is something which I've been very passionate about, and I've been thinking about this question about how do we allocate between equity and debt. We actually spent almost 2 years trying to develop this model. What we discovered is there were four factors which were deterministic of what should be the market movement in terms of the equity. We chose these four parameters after doing a lot of back testing, the historical data. We looked at PE ratio, price to book, dividend yield, and the earnings yield gap. And we were focusing on these four parameters to determine what's the net equity model that we're going to be having for this fund. After back testing the data, we realized that it can be deterministic in terms of an accuracy of about 90 to 95% of the market movement. And that's how we've chosen these four parameters. And the way it works is we rebalance the portfolio on a monthly basis based on the outcome of this deterministic model. And we look at the past data rather than the future data. And once we look at the past numbers, we arrive at what's the net equity allocation that we should be having.
So what is the maximum equity that you touched in the last 5 years, and what is the lowest?
Sure. So the net equity allocation in this product, we've defined it as between 30 to 100%. And the way the model actually works is whenever the market is at a significant higher valuation, the net equity allocation goes down. When it is very cheap, it goes all the way to a higher level. In the last 5 years, the highest we've touched is about 89 or 90%. And mind you, this is at the time of the peak of COVID. Sometime in the month of May, June of 2020, our net equity allocation moved up from about 40% to all the way to 90%. The way to look at it is not really that the market has fallen. I would actually say that the valuations which came down to all the way to -2 standard deviation on all the parameters.
Prashant, how have you worked around the allocation of debt? Of course, there's the overarching principle that Sanjay just explained, but can you tell us a little about how the debt allocation has played out? This is really a space people don't probably get to know much about compared to equity. So if you could explain how you have aligned your style towards the debt component in the BAF.
So the debt allocation at the umbrella level, you will get the debt allocation from the model itself, which is a proprietary model, and within that debt allocation, we decide as to how to run the strategy or what is the investment philosophy, which is very important from a portfolio perspective. From an investment philosophy perspective, we follow a very different philosophy, and we run a very conservative kind of portfolio as far as interest rate risk goes or even credit risk goes. Now, why conservative? Obviously, because debt is from a stability perspective. So you don't take an aggressive digital duration calls or aggressive digital credit call. From an interest rate perspective, we clearly run a low to moderate duration into our balance advantage fund, which ensures that we navigate the markets in all different kind of scenarios. From a credit perspective, clearly a well-defined research process or a well-rated papers are taken into this fund so that accruals are taken care of. When you look at, say, duration management, accrual management along with credit, obviously one important factor in both these parameters is liquidity. So the fund relies on three pillars basically: accrual, liquidity, and duration management on a conservative basis. So in all kinds of interest rate scenario, you will see that the fund is performing on a risk return paradigm.
How much of your portfolio, the debt portfolio, would you say is tilting towards government securities? And do you at all take credit risk? Because, we all know about the big accidents that have happened in the past. And so what kind of a proportion to get that little kicker? Do you at all go into looking at credit risk, or do you just stick to government, PSU, top-rated corporate bonds?
So we have a decent allocation as far as the portfolio goes into AA and AA plus security. Majority of the portfolio below AAA is concentrated only into AA plus and AA, which takes care of the accrual. We decide on the allocation of this AA and AA plus depending on the liquidity requirement of the overall portfolio. And for liquidity requirement, as you rightly said, we are allocating money to sovereigns and AAA PSUs or CPCDs overall in the portfolio. And we combine these two to achieve our duration and accrual objective. And finally, when we combine all this, we get the liquidity, what is required at any point in time in the portfolio to be fulfilled.
Sanjay, when you pick your stocks, do you get overly concerned about large cap, mid cap, small cap, or do you simply put it through the test of it meeting the three criteria that you described? Because a lot of the commentary we see comes around, saying, oh, the mid caps have fallen sharply, or the small caps have fallen sharply, or there's opportunity here, opportunity there. But, the biggest small cap in the category is also an 18,000 crore value company. So, do you look at or get obsessed with categories that you're picking or stocks that you're picking, irrespective of which category they're from?
Vivek, for a balance advantage fund, we use a flexi cap approach in terms of investment style. And we are not really constrained that we need to be large cap or mid cap or small cap focused. And if I look at my data for the last 5 years, we've moved our allocation from on the net equity portion from about 90% when we launched the fund to at present we are at about 65% large cap, the balance being mid and the small cap. So as I started off and I said the art part is in terms of the bottoms up in terms of stock picking. After we've decided what is the sector allocation that we're going to be having, we look at GAP in terms of what are the stocks which are looking at attractive in terms of growth, what are the valuations. Then it does not matter what is the market cap per se. Having said that, more from a risk perspective, we may allocate some bit for the large cap, irrespective, okay, to provide some kind of a stability, etc. So, as an overarching philosophy, it's a flexi cap approach, and we've demonstrated that. We've moved the allocation from large to mid and the small cap. And I'm with you. I agree with you. I think the category in terms of market cap between 10 to 45,000 crore offers significant growth opportunities in terms of investments and the companies. And I think that's where the alpha is also being generated out there. And that's something that we also focused out there. But the approach is essentially a flexi cap approach. We can move all the way up or down At the moment, we are positioned as more like a flexi cap where 65% is large cap and the balance is mid and small.
I was reading some data that around your fund, and it says that it has given 91% of the Nifty returns with only 58 net equity allocation, 58%. Can you explain that?
Sure, Vivek, it's been 5 years since we launched this fund, and every time I go out, people are really surprised with this data. But we are really not surprised, and the reason being, before we launched this fund, we spent a lot of time in terms of researching about the model, and we realized that the numbers that you spoke are in line with our expectations. So, well, the market participants are surprised. We are not, and it's more or less in line with what we've been looking at. And if I look at the last 5 years data, we've seen all kinds of markets. We've seen sharp fall during the COVID, post-COVID. We've seen a sharp rise, sideways movement, trending markets, etc. What you need to appreciate is, and really the secret sauce is in terms of the right allocation that we make. There are two asset classes that we look at, or technically there are three. We have equity, we have arbitrage, and the debt portion. Arbitrage is more like a filler. Whenever the net equity allocation is less than 65%, we do a single stock arbitrage. So effectively, we need to compare what are the opportunities, or where is the value zone between the equity and the debt. And there is a fundamental parameter that we look at, what we call the earnings yield gap, which actually captures what is the market valuation, the equity market valuation vis-a-vis the 10-year G-Sec, and what is the opportunity out there. So effectively, if you are effectively managing the net equity between the two asset classes, with the kind of opportunities you would have, that's the kind of a market participation that you would end up with. And one thing that I would also like to highlight is, on a risk-adjusted basis, if you have this kind of a high participation, on a risk-adjusted basis, you're doing pretty well in terms of the returns.
Prashant, when it comes to investing or mutual funds or equity, people, the two big fears that they have, one is, of course, that, equity market, my capital can get wiped out. And I think over the last 2-3 decades, this perception has changed, that it's not like that if you come with a investment discipline and not trading, you may not, the loss of capital if held for a long term is unlikely to happen. But the volatility that I think continues to scare people. And do you believe that that is the one big reason or a very important aspect of a balanced advantage fund?
One very important thing from a debt perspective, which I would like to cover, is basically how are you navigating the portfolio in different interest rate scenarios, and to achieve the purpose what you just recently said, that many a times the market move in such a manner that it gives a lot of volatility to any kind of portfolio. So yes, volatility is part and parcel of this portfolio. But how we try to avoid or how we try to navigate through this different interest rate scenario is basically to maintain a duration in a low to moderate duration zone, because of which what happens is that even when yields are going up, your accrual becomes important over a period of time, and most of the investors into such kind of portfolios are medium to long term. So the kind of expectation they have from the overall portfolio, or what the debt portfolio delivers in the overall portfolio, is to avoid maximum volatility when the markets are very, very volatile, and when the markets are basically good, when the yields are falling, your portfolio should have the flexibility to change the duration, which is possible because of eternal liquidity into the portfolio. So low to moderate duration basically helps the portfolio to basically maintain the return in a certain acceptable ranges and not give volatility in any kind of market. So that is the basic intention of the debt allocation into this portfolio. Just I'll give you a comparison that supposing if it's a high duration kind of fund, so where I have the flexibility to go on higher duration whenever interest rate scenario is favorable. So as compared to that portfolio, the duration ranges are quite constrained into this portfolio, which takes care of this aspect to a very large extent.
Prashant, when it comes to debt, in simple terms, it is explained that your debt returns are determined by the interest rate cycle. And, we at this point certainly, are of course, nobody can predict the future, and I'm not asking you to do that, but we've been in a bit of a pause mode with an expectation that from here on, there are higher chances of interest rates coming down than of them going up at this point. So from, again, an investor's point of view, how would you explain the interest rate and the how do you change your allocation according to that?
Yeah. So, say for example, the current scenario or the past 1.5 year scenario when the rates were going up, where Reserve Bank of India hiked the overnight rate or the repo rate by say 250 basis point. So, in such a scenario, what happens is I have a control on the duration, which actually takes care when the yields are going up. Your duration is managed in such a manner that the impact on the portfolio is expected to be on a very minimum side. And when you are at a current stage where the expectations are that you are at the fag end of a hike cycle, or you might be looking at stagnation for a period, in such a scenario, I would be managing the duration in such a manner that it will be slightly higher than the last 1.5 year when the rates were going up. And in such a scenario, when interest rate comes down, the duration automatically helps the portfolio in garnering good returns. And at every point in time, whether the interest rates are falling or going up, the credit strategy is managed in such a way that the accruals of the portfolio are quite healthy, and that helps in compensating the returns over a period of time.
One final question, Sanjay. Most of the biggest financial planners, advisors, they say that 90% of your returns come through asset allocation. And having spent more than 3 decades or close to 4 decades in this financial market, and today you're managing something which is actually a asset allocation product. Could you explain to viewers how important is it to not get swayed by the flavor of the season and just stick to a good asset allocation plan for the long term?
So you're right, Vivek. I mean, it's been proven that asset allocation determines the 90% of your return out there. But I think within the asset allocation, it's very important to understand which asset you are really looking at and what is the kind of a return that you're going to be making. What Baroda BNP Balance Advantage Fund actually offers is an effective allocation between debt and equity, where you really don't have to worry and try to time the market, because the model is a deterministic model. It is using fundamental parameters. Intuitively, whenever the markets are expensive, it does the reallocation towards debt, which would also mean that you're going to actually capture most of the rally in the debt market. We are actually investing across the market cap. We are really not focused on large, mid, or small cap, and effectively trying to get the best of all the 3 parts, both in terms of the asset allocation, both in terms of the equity part, in terms of market cap and in terms of the fixed income, which Prashant is effectively running out there. So that's, I would say, is the best way to look at this product rather than trying to second guess. And I would also add that typically whenever the markets react are in the negative zone, we've seen that during the Russian-Ukraine crisis. We've seen it recently also when the people were a little apprehensive in terms of equity markets. The model actually determines it. So it takes away the emotions while investing. And I think that's a very critical part because the model is hardcore science.
And are you regulatorily constrained to stick to only debt and equity, or can you, if you so decide as fund managers, go into, say, gold, global investing, private equity?
So in a balanced advantage fund, yes, that's what we have determined in the SID, that we will be looking at equity and debt only. We do have other products in terms of multi-asset. We are looking at equity, gold, and debt. All our products have an enabling provision to look at overseas investment. As a house, we believe that we will only invest in those asset classes or those securities that we understand. At the moment, we don't believe we have the capabilities to invest in the overseas market, and we'll stick to what we understand.
An absolute pleasure talking to both of you. Thank you very much for coming by. I wish you lots more success and congratulations on completing 5 years with this fund. Hope to see many, many more years and many more conversations. Thank you.
Thank you, Vivek. It's been a pleasure speaking to you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.